95% of traders would enter the position right here because they see the price has moved up after hitting the order block. Little they know that in the near future the price would stop them out, and they wonder, why does that happen? Well, because you are probably not using order blocks in a proper way. So in this video, you will learn what are order blocks, how to identify order blocks, and the rules of the order blocks that need to be respected in order for them to qualify as being a high-quality order block. So hopefully by the end of the video, you will learn which order blocks will work and which will probably not work. And lastly, we will present to you a strategy to trade these order blocks. So what are order blocks? Order blocks are basically just areas where smart money traders are positioning their buy or sell orders in significant amounts. You need to understand that the market moves based on liquidity. The price is like a magnet for liquidity. It moves where the most liquidity is placed. So the market needs liquidity to create such large price movements, and it needs a lot of it. This is an example of an order block, and specifically a bearish order block, where the price moves up just around the order block area, where smart money traders often place their limit orders, and these orders are so large compared to the retail traders' orders that price has a sudden reaction, and that creates a lot of volume and therefore liquidity in the market. So the question is, how can we identify order blocks? We will present a three-step simple process to identify order blocks. The first step is to find an aggressive or significant move. This move is what we call an inefficiency, where price has moved all of the sudden very aggressively in one way. That is most probably caused by smart money entering the market with large-sized orders that gave no chance for sellers to react. So what often happens is the market wants to rebalance or keep efficiency. So price comes back down that area to fill the inefficiency. The second step is to identify the candle before the inefficiency was created. So we are talking about the last candle before the sharp aggressive move. And the third step is marking the order block, which is the high and low of the last candle before the significant move. So basically just marking the highs and lows of the candle that we identified on step 2. And that is the order block. You need to know that not all order blocks are respected. Some order blocks do not present any important inefficiency, so they get filled right away, and you don't want to take trades on filled or mitigated order blocks. A certain order block can only be used once, so reusing the same order block is very dangerous. However, when price fills the order block, the market can create a new order block as long as the rules are respected. But the new order block is always above or below the previous one, so keep in mind that we do not reuse the same order block. To understand if an order block is valid, there are few rules to look for. The first rule is the inefficiency must be present. There must be a gap created on the market. That leaves us more clues that smart money really entered their positions around that zone. So exactly like in this case, the high of the previous candle with the low of the candle next to the aggressive move. This is the price gap. This is our inefficiency that could get filled later on, making this a valid order block or a high-quality order block. And this is how price looks without an inefficiency. Look how the wicks take basically the liquidity of each part. So we basically have no gap between price. This is an efficient market where smart money likely didn't participate in this certain move. And this makes this an invalid order block or a false order block. The second rule is that the price should create a break of structure. So what is the break of structure? For example, we know that in an uptrend price doesn't just go straight up. Price has to go top, then retrace and so on. So basically it creates higher highs and higher lows. The break of structure is created once the current price breaks the structural previous high. Keep in mind this is for the uptrend. But on a downtrend it is the other way around, so price creating lower lows and lower highs. By the price breaking the previous structural low, that represents the break of structure in the bearish market, or, as we will likely call it, a bearish break of structure. We can see how the origin of the break of structure is the candle that forms the order block, because that candle marks the highest point of that structural movement. So price comes back up to refill or mitigate the bearish order block, and it clearly shows a strong rejection with a wick. It couldn't even close a candle inside. That shows smart money were probably opening large-sized sell-short positions, and for later price to break structure again and form another order block in which we expect for price to come back up and do reject to the downside once the inefficiency gets filled. The third rule is something that we already mentioned a couple minutes before. The third is that the order blocks are one-time use, and let's present an example for you to understand. So we have the eurodollar on the 1-minute time frame. Right now it's in a kind of slow uptrend. We see the formation of a high, a low, the break of the high which marks the bullish break of structure. Then price sets a high that hasn't touched yet. But the important detail is that the next low is higher than the previous set low for the next one too. We also see the next low being higher than the previous one, so this is a huge indication of an uptrend. For extra confirmation, we look the near past to spot, the price action, which shows that price was initially in a downtrend and reversed into an uptrend. So having confirmed that we are in an uptrend, we look for bullish order block formations. Like at this level where price suddenly moved up, leaving this area being inefficient, and the order block is the last candle before the impulsive move, so we take the candles high and low, and wait until price fills the area back, right here. This being a bullish order block in an uptrend, we look to buy long, with the stop loss below the order block and the take profit above the previous more important high. We want a risk to reward ratio of minimum 1 to 2, and we win the trade. Now the second and third rule applies. Let me explain. So notice again another impulsive move created right here. Is this another order block? The second rule isn't respected. Notice how this wick fills the order block, so there is not a significant inefficiency created. And the third rule is that we do not reuse order blocks. So the previous one was at this zone. This is named as an already mitigated order block. What usually happens, and we do not want this to happen to us, is by taking low-quality order blocks, price fills them, then moves for a short time to the upside, giving traders confidence that the order block will hold. And then it breaks both the next order block and the previous order block, resulting in traders getting stopped out. With this example, we have explained the second and third rule combined. Now let's dive into the trading strategy we can use to trade order blocks. For this strategy, we need to know 3 important things: market structure shift, and order blocks. We have covered the market structure in the past, so if you are new or a beginner, you can always look up for those videos to understand. So let's take the strategy in order, starting from the bullish scenario. So we have a high, a low, and a higher high. So we have a break of structure. But after that, price couldn't hold the previous low, and instead it broke it down, creating a lower low. So process is called market structure shift. The price action has shifted from an uptrend to a potential downtrend. So knowing a downtrend is a price action that creates lower lows and lower highs, considering this is the first lower low. From the downtrend, we know that the most likely scenario is for price to create a lower high, so a high lower than the previous one. And we want to look for is an inefficiency and a potential order block near the high. Us waiting for price to fill the inefficiency, therefore the order block, area where we can look to sell short with take profits below the previous low, since we are expecting the downtrend to continue to break structure low. And now considering a bearish market. So price following a downtrend by making lower highs and lower lows. So what we want to see is a market structure shift. Remember that the shift is a trend reversal. Therefore, what we look for is price breaking the previous lower high. And this creates the market structure shift. So after that happens, we want to look for an inefficiency on the lower low and find if there is a significant order block near that area. So we wait price to fill the order block and buy based on the information that the market has shifted into an uptrend. So we expect price to break the previous high, and that is our take profit. And the stop loss, we usually set it below the order block zone. Now it's time to put it all together. At the first glance, we can easily see this market is a downtrend. Therefore, notice the bearish break of structure that simply creates a lower low by breaking the last low, so we mark the zone. There is another break of structure that pushes the price down into an aggressive and quick downtrend until this reversal candle prints on the chart. Be careful, as this is not an order block, or at least it's not a high-quality one, since the second rule is not respected, so there is not a significant inefficiency, and the small imbalance got filled instantly by the next candle. So after price has hit a high, and then the retrace is higher than the previous low. So this is the first major indication of an uptrend, so let's see what price does. It has broken the previous high, which confirms the reversal into an uptrend. So this becomes our market structure shift indication. By the way, You will also see the market structure shift named as a change of character. They indicate pretty much the same thing, which is a confirmation of a reversal. So now we can spot the inefficiency and mark the order block, which is the last candle before the significant bullish price reversal. And what we look for is price to come back to fill the area where we can look for a buying opportunity and follow the price to potentially break the past high, since this is an uptrend, and patience until price comes back to the zone. You can set alerts into the zone in TradingView. Now we also know the uptrend confirmed with the bullish break of structure that broke the high. And the zone has finally filled. For more advanced traders, we can switch to a lower time frame. So into the 5-minute time frame and look there for another order block to enter a trade. And this becomes the micro order block inside the macro order block. So it double confirms the validity of a high-quality order block. If you are even more advanced, you can switch to even a lower time frame, for example, into the 1 minute and spot a higher risk to reward ratio trade, but in most cases it is not needed. This is more than enough. So we buy the mitigation stop loss below the micro order block, so the order block in the lower time frame, and the take profit to at least 1 to 2 risk to reward ratio. But I usually go for 1 to 3. What we want is price to break the last high, which basically is just creating a break of structure inside the smaller time frame, and that is the most advanced strategy. Now let's look at something more simple. At the first glance, this is bullish market, so we start marketing the breaks of structure to the upside. Right here, here another one, and another one. And this is the last one. We got a market structure shift or a change of character. So this bullish market has flipped into a bearish market by breaking the last significant low. Now we mark the first order block spotted and leave price moving. Another sharp downside movement which prints right here that we got another bearish order block. The first order block got filled. Now we move into a lower time frame. This was the 4-hour time frame. We will move into the 30-minute time frame. Now we have multiple choices. We can sell short right at the touch with the stop loss above this specific order block and take profit of around 1 to 2 or 1 to 3 risk to reward ratio, or even lower down the previous important lows. Let's leave price to move for a bit more to see more information. So let's assume we didn't enter the trade and we are waiting. So it has touched the zone again, giving traders another opportunity to enter. Even if you would have missed this exact entry, after seeing the instant rejection after the order block has been filled, you would have had the chance to enter the trade after the candle is closed, so it still should get you a decent risk to reward position. And it closes as a win. You got two approaches, the more complicated one, which was the previous example, and this one, which is more simplistic. This is all for today's video. Thank you for watching. If you found it helpful, feel free to leave a like and subscribe to our channel. See you in our next video.